Hi everyone, I'm Anna of Valur and today we'll talk about exchange funds. We'll explain what exchange funds are, how they work and the benefits and potential downsides of using them. By the end of this video, you should have a better understanding of how exchange funds can help you diversify your investments and potentially save on taxes. So let's get started. An exchange fund, also known as a swap fund, is a type of investment vehicle that allows investors to defer taxes on capital gains by diversifying their savings. Exchange funds are similar to mutual funds, but instead of contributing cash, investors contribute stock. By aggregating the concentrated stock positions of multiple investors, an exchange fund allows you to substitute or replace your own concentrated stock position with a diversified basket of stocks of the same value. This helps to reduce portfolio risk. One of the main benefits of using an exchange fund is that the transaction is not immediately taxed. This allows investors to diversify their investments without having to pay taxes upfront. Additionally, the limited partnership structure of exchange funds allows investors to swap highly appreciated stock for shares in these entities without triggering capital gains tax. To qualify as an exchange fund, at least 20% of the portfolio must be invested in illiquid assets such as real estate. Additionally, in order to qualify for favorable tax treatment, investors must hold their fund shares for at least 7 years. At the end of this period, investors have the option to receive a basket of stocks, none of which is their original stock. The number of stocks received varies by fund, but is usually at least 20 or 25 different securities. The benefits of exchange funds include instant diversification without immediate tax consequences and the ability to achieve long-term capital gains, tax rates on the sale of the received stocks. However, exchange funds also have some downsides. For example, they require a 7-year holding period, and investors may face fees and additional taxes if they sell their equity before this time. Exchange funds also typically have high management fees and contribution minimums, and most are not marginable, meaning investors cannot take out loans on the assets they have contributed. An example of how an exchange fund works is as follows. Let's say you have a low basis concentrated stock position worth $5 million and you want to diversify your investments. If you were to sell the stock, you would incur federal and state taxes totaling approximately $1.5 million, depending on where you live. This would be the scenario with the highest tax exposure. If you decided to use an exchange fund instead, the fund may be able to absorb the $5 million worth of stock. In order to participate, you would have to certify that you are a qualified investor. The ongoing expenses for the fund would be 150 basis points per year, and you would have to hold the fund shares for at least 7 years. After this period, you could receive a basket of stocks worth $5 million with a new cost basis. None of these transactions would be subject to taxation until you actually sold the received stocks. This would allow you to defer the taxes on your capital gains until later and potentially achieve long-term capital gains tax rates on the sale of the received stocks. All right, that wraps it up. I hope you liked the video. If you have any questions, please let us know in the comments below. And please like, share, and subscribe to learn more about all types of tax-saving opportunities. Now, a quick word about Valur. We have built a platform to give everyone access to the tax planning tools of the ultra-rich like Facebook founder Mark Zuckerberg and others. We make it simple and seamless to pick the best strategy, set up and administer these structures at a fraction of the cost of competitors. If you still have any questions, you can visit our website at valur.io. You can read our content on tax planning strategies. Play with our online calculator to discover your financial gains by picking different trusts or schedule a call with us.